The greatest heists in history are never committed with guns, masks, or explosives. They're committed with mathematics. They happen in silence, buried under layers of complex financial data, invisible to the average person until the vault is already empty. Right now, as you watch this video, a fleet of cargo ships is moving across the Pacific Ocean. They are heavy, sitting low in the water. They're leaving the ports of London and New York, and they're heading toward Shanghai. These ships are not carrying consumer electronics or cheap plastic toys. They are carrying the lifeblood of the modern world. They are carrying the physical wealth of the West: gold, copper, and most critically, silver. For the last 20 years, we have been told that the trade war is about tariffs, sanctions, and political rhetoric. This is a distraction. The real war is being fought on the ledger. While Western investors are distracted by the flashing red and green lights of the stock market, chasing the price of paper assets, the East is quietly seizing the value of physical assets. We are witnessing a structural shift in the global order. It is a phenomenon that economists call the Great Wealth Transfer. But let's call it what it really is: the Great Silver Heist. And the most terrifying part? The West is voluntarily handing over the keys. To understand how this robbery works, you have to understand the illusion of price. You open your phone, you check the price of silver, you see a number, let's say $30. You assume this is what silver is worth. You assume this price is discovered by supply and demand. You are wrong.
That number on your screen is not the price of physical silver. It is the price of a digital contract, a promise, a piece of paper traded on the COMEX in New York or the LBMA in London. It is a casino where banks trade bets on silver that doesn't exist. For every 1 ounce of real silver in the vault, there are hundreds of paper claims traded against it. But 7,000 miles away, in China, there is a different market, the Shanghai Gold Exchange. Unlike the West, the SGE is a cash market. It is a physical market. If you buy silver in Shanghai, you don't get a piece of paper. You get the metal. You take delivery. And here is the smoking gun. For the last several years, the price of silver in Shanghai has been significantly higher than the price in New York. We call this the Shanghai Premium. In a normal, healthy market, this difference would disappear in minutes. Arbitrage traders would buy low in the West and sell high in the East, equalizing the price. But the gap isn't closing, it is widening. Why? Because this isn't a market inefficiency, it is a vacuum. China knows something the West ignores. They know that the paper price in New York is suppressed, it is artificial. So they are using the West's own rigged system against it. Think about the genius of this strategy. The Western banks suppress the price of silver to protect the US dollar. A low silver price makes the dollar look strong. China looks at this artificially low price and says, "Thank you." They use their surplus trade dollars, the very dollars Americans print to buy Chinese goods, and they send those dollars back to the COMEX. They buy the physical metal at the suppressed Western price, they load it onto those ships, and they bring it home to the Shanghai vaults. They are draining the COMEX dry, using the COMEX's own manipulated pricing to do it. It is the financial equivalent of buying dollar bills for 50 cents. Every month, thousands of tons of silver leave the LBMA vaults in London. They never come back. They are melted down into 1 kilo bars stamped with Chinese characters and locked away into strategic reserves. But why silver? Why now? The mainstream media will tell you it's just jewelry demand or industrial use. Do not believe them. This accumulation is strategic. It is a preparation for a post-dollar world. China understands that the next global conflict will not be fought over borders. It will be fought over supply chains. And silver is the single most critical element for the technology of the 21st century. Without it, there are no missiles, no satellites, no solar panels, no electric vehicles. By draining the West's physical inventory, they are not just making an investment, they are deindustrializing their rivals. They are ensuring that when the music stops, they hold the chair and the West holds the bag. However, this great heist requires one more ingredient to succeed. Buying the silver is the first step, but to truly break the Western financial system, you need to collapse the currency that the system is built on. You need the dollar to fail. For decades, the US dollar has been propped up by a silent partner, a loyal ally in the Pacific who bought American debt no matter what. But that ally is now in trouble. The mechanism that kept the dollar alive is reversing. To understand the endgame, we have to look away from China for a moment and look at the ticking time bomb in Tokyo. Because what is happening in Japan right now is the trigger that will turn this heist into a global catastrophe. For 30 years, the global financial system has relied on a single, silent assumption that Japan would always keep its interest rates at zero. This assumption was the bedrock of the US dollar's strength. It was the foundation of the American bond market, and it was the engine that allowed Wall Street to gamble with trillions of dollars of leverage. But that foundation has just cracked, and the noise you hear in the distance is the sound of a structural collapse beginning to accelerate. To understand why a decision made in Tokyo destroys the value of the money in your pocket, we have to look at the carry trade. This is the financial mechanism that has artificially propped up the Western economy for decades. The mechanism was simple. Large institutional investors would go to Japan and borrow billions of yen. Because the Bank of Japan kept interest rates at rock bottom, often negative, this money was essentially free to borrow. Then these investors would take that borrowed yen and sell it to buy US dollars. With those dollars, they would buy US Treasury bonds that paid 4% or 5% interest. It was the perfect arbitrage. They were borrowing for free and getting paid to hold American debt.
This trade created a massive artificial demand for the US dollar. It made the dollar look stronger than it actually was. It allowed the US government to run massive deficits because there was always a buyer for their debt. Japan wasn't just an ally, they were the liquidity provider for the American empire. But in economics, there is no such thing as a free lunch forever. The pressure on the Japanese yen became too great. Inflation finally arrived on their shores. To save their own currency from becoming worthless, the Bank of Japan was forced to do the unthinkable. They began to raise interest rates. They began to tighten monetary policy. This singular act is the pin that pops the bubble. When Japan raises rates, the carry trade stops working. Suddenly, it costs money to borrow yen. The hedge funds and banks that are leveraged to the hilt are now staring at massive losses. They have to close their positions. And here is where the dominoes fall. To pay back their yen loans, they have to sell their US assets. They have to sell US Treasury bonds. They have to sell the US dollar. We're talking about the potential unwinding of a trade worth trillions. This creates a massive wave of selling pressure on American debt exactly when the US government needs to borrow more money than ever before. This brings us back to the geopolitical chessboard. Remember the pincer move. While Japan is selling US debt out of necessity to save their own currency, China is selling US debt out of strategy.
For years, China was the largest foreign holder of US treasuries. They recycled their trade surplus into American bonds. But look at the data from the last 24 months. China has been dumping US treasuries at a record pace. They are liquidating their position. So ask yourself, if the two biggest buyers of US debt, Japan and China, are now selling, who is going to buy it? There is only one buyer left, the Federal Reserve. The US government cannot allow the bond market to crash. If bond yields spike, the interest on the national debt, which is already over $1 trillion a year, will consume the entire federal budget. The system would freeze. So the Federal Reserve will be forced to step in. They will have to print trillions of new dollars to buy the bonds that Japan and China are selling. They will have to monetize the debt on a scale we have never seen before. This is the cycle of collapse. Japan sells, China sells, the Fed prints. Every new dollar printed dilutes the value of the dollars you worked for. It is the textbook definition of a currency crisis. We are moving toward a moment where the US dollar is sacrificed to save the US bond market.
This is exactly what Beijing has been waiting for. They know that as the Fed turns on the money printer to absorb this selling wave, the purchasing power of the dollar will evaporate. The paper wealth of the West will burn in an inflationary fire. And when a currency begins to die, capital does not just disappear, it moves. It flees from the dying asset into the living asset. It flees from the abstract to the concrete. Smart capital is already seeing the writing on the wall. They know they cannot hold bonds. They cannot hold cash. They need to hold something that cannot be printed, something that is essential. This brings us to the third and most critical part of this structural shift. China hasn't just been selling dollars, they have been cornering the market on the very materials that will power the next century. While the West is worrying about the stock market, China has been securing a monopoly on the periodic table. And there is one metal in particular that is about to experience a supply shock so severe it will bring entire industries to their knees. The industrial vacuum is turning on. For the last 50 years, the geopolitical map of the world was drawn in oil. Every war, every alliance, every coup was ultimately about who controlled the flow of black gold. But that era is over. The map is being redrawn, and the new lines are not being traced in oil, but in metal. The West has committed itself to a new religion called net zero. Governments in Europe and North America have passed laws banning internal combustion engines, mandating solar grids, and subsidizing electric vehicles. They have bet their entire economic future on the green transition. But there is a fatal flaw in this plan, a flaw so obvious that it seems impossible they missed it, yet so critical it ensures their defeat. The green transition is not a political decision, it is a materials problem, and the West does not have the materials. To replace fossil fuels, you need to electrify everything. To electrify everything, you need copper, lithium, cobalt, and above all, silver. Silver is not just a monetary metal, it is the most conductive element on the periodic table. It is the irreplaceable nervous system of the modern world. You cannot build a solar panel without silver paste. You cannot build an electric vehicle without silver contacts. You cannot build a Tomahawk missile, a 5G tower, or an AI server farm without silver. It is the strategic choke point of the 21st century. And China has had its hand on the throat of this supply chain for decades. While Western politicians were giving speeches about carbon emissions, Beijing was quietly buying mines in Africa, South America, and Asia. They were building massive refining facilities. Today, China processes over 80% of the world's cobalt, dominates the lithium market, and controls the vast majority of solar panel manufacturing. They understood a simple truth. He who controls the refining capacity controls the world. Now, consider the mathematics of the silver market. The solar industry alone is consuming silver at a rate that is terrifying geologists. As solar technology becomes more efficient, it actually uses more silver, not less.
We are seeing year-over-year deficits in silver production. We are mining less than we consume. The above-ground stockpiles are being eaten away. This is where the industrial vacuum begins to destroy the Western narrative. The West is trying to build a high-tech, green economy on a foundation of resources it does not own. They are printing trillions of dollars to subsidize green energy projects, but those dollars are immediately flowing out of the country to buy the physical metal needed to build them.
Where does that metal come from? It comes from the East. So, we have a situation where the U.S. Federal Reserve prints currency to fund a green revolution, and that currency ends up in the vaults of the Shanghai Gold Exchange, which then uses it to drain the remaining physical silver from the West. It is a suicide loop. The more the West tries to go green, the more wealth they transfer to their systemic rival. And China knows the geology. They know that silver is finite. They know that at current consumption rates, the accessible reserves of silver are running dangerously low. By accelerating their accumulation now, they are cornering the market before the shortage becomes public knowledge. Imagine a world where Ford, Tesla, or Apple have to stop production, not because they lack money, but because they physically cannot source the silver needed for their circuit boards. Imagine a world where the price of silver isn't determined by a paper contract in New York, but by the factory owner in Shenzhen who refuses to sell his stockpile. This is the definition of a supply shock.
The West has lived in a fantasy where price solves everything. They believe that if the price goes up, more supply will magically appear. But geology does not negotiate with economics. You cannot print silver. You cannot quantitative ease a silver mine into existence. It takes 10 years to bring a new mine online. We do not have 10 years. We are walking blindly into a wall. The inventories at the COMEX and the LBMA are bleeding out. We are tracking the eligible and registered silver ounces in these vaults, and the trend line is catastrophic. It is pointing towards zero. And this brings us to the final and inevitable conclusion of this heist, the moment when the mathematics of the paper market collides with the reality of the physical shortage. Throughout history, every time a paper currency system meets a physical shortage, the result is the same. It is not a gradual rise in price. It is a sudden, violent break, a moment where the rules of the game are suspended. The legal term for this is force majeure. It is the moment when the bank looks you in the eye and tells you that the contract you hold is worthless because the metal isn't there. And when that declaration is made, the world changes overnight.
The financial world is built on confidence. It is a shared hallucination where we all agree that a piece of paper or a digital entry on a screen represents real value. But confidence is fragile. It takes decades to build and only seconds to destroy. We are now approaching the moment where the confidence in the Western paper silver market evaporates. In the industry, we call this the force majeure event. Most investors have never read the fine print of the contracts they hold, whether it is an ETF, a futures contract, or an unallocated account at a bullion bank. The terms of service contain a trap door, a clause that allows the institution to suspend redemptions in the event of extraordinary circumstances. What constitutes an extraordinary circumstance? A shortage of metal. Imagine the scene. It's a Tuesday morning. The price of silver has just jumped 10% overnight because a major mine in Mexico has been nationalized or a conflict in the South China Sea has severed supply lines. Panic begins. Thousands of investors who hold paper silver decide that they want to convert their paper into real metal. They want delivery. They call their brokers. They submit the paperwork. But the vault is empty. The metal isn't there. It is in Shanghai. It is in Mumbai. It is in the components of 1 million solar panels. At this moment, the COMEX declares force majeure. They invoke the cash settlement clause. They tell you, we cannot give you the silver, but don't worry.
We will give you the cash equivalent at the last closing price. This sounds fair until you realize the trap. They are forcing you to accept a dying currency, the dollar, in exchange for the very asset that is protecting you from the death of that currency. They hand you paper that is losing value to pay you for the metal that is skyrocketing in value. It is the ultimate rug pull. This is the moment of the decoupling.
We will see two prices for silver. The paper price on the news, which might be managed and suppressed, and the street price for actual physical metal, which will be multiples higher. You will see the spot price at $35, but if you walk into a coin shop or call a dealer, they will tell you there is no inventory, or they will tell you the real price is $100. The paper market becomes a ghost town, a museum of lies. The physical market becomes the only reality. This has happened before. It happened with nickel on the LME. It happened with palladium. But when it happens to silver, the poor man's gold, the shock wave will tear through the entire global economy. China has anticipated this. By draining the West of physical inventory now, they are ensuring that when the decoupling happens, they hold the leverage. They will set the price. If Apple needs silver to make iPhones, or if Raytheon needs silver to make missiles, they will not be able to get it from the COMEX. They will have to go to the source. They will have to knock on Beijing's door. And Beijing will not ask for dollars. They will ask for yuan, or gold, or geopolitical concessions. The heist is nearly complete. The transfer of wealth is in its final stages. The West has traded its real assets for cheap consumer goods and debt. We have hollowed out our vaults to fill our garages with plastic. We gave away the family silver to keep the party going for a few more years. But the lights are coming on. The music is stopping. So, where does this leave you? You are standing on a train track. You can feel the vibration of the engine. You can hear the whistle. But the conductor, the government, the central bank, the media, is telling you that the train isn't coming. They are telling you to stay on the tracks. They are telling you that inflation is transitory and the banking system is sound. You have a choice. You can believe the narrative or you can believe the math. The math says the vaults are draining. The math says the debt is unpayable. The math says the industrial demand is impossible to meet. This video is not just a history lesson, it is a warning. The window to exchange your paper currency for physical assets is closing. There will come a day, perhaps very soon, when you cannot buy silver at any price. It will simply be unobtainium. Do not wait for the news anchor to tell you it's time to panic. By then, it will be too late. The premiums will be astronomical. The inventory will be zero. The Great Silver Heist is not a theory. It is a forensic fact. The metal has moved. The power has shifted. The dollar is dying. History shows us that in every collapse, there are those who lose everything because they trusted the system, and there are those who preserve their wealth because they trusted themselves. The system is designed to strip you of your assets. The only way to win is to exit the system. Become your own central bank. If you don't hold it, you don't own it. Paper burns, silver remains. The heist is over. Now the survival begins.